Sophie from Azuma, and I'm here today to explain what a director's loan account is. If you have a limited company, you may hear the term director's loan account or DLA mentioned. So what is it? A director's loan is money you take from your company's accounts that cannot be classed as salary, dividends, or legitimate expenses. To put it another way, it is money that you as director borrow from your company and will eventually have to repay. Another kind of director's loan is when a director lends money to the company, for example, to help with startup costs or to see it through cash flow difficulties. As a result, the director then becomes one of the company's creditors, so the company owes you as a director money. The director's loan account is where you keep track of all the money you either borrow from your company or lend to it. If the company is borrowing more money from its director than it is lending to it, then the account is in credit. However, if the director borrows more, then the DLA is said to be overdrawn. Be aware that shareholders and perhaps other creditors may become concerned if your DLA is overdrawn for any length of time. You should aim to ensure that most of the time it is either in credit or at least at zero. Something to be aware of is that if you lend your company money and you can be paid interest on the balance, it is up to your company what interest rate it charges on a director's loan. However, if the interest charge is below the official rate, then the discount granted to the director may also be treated as a benefit in kind by HMRC. This means that you as director may be taxed on the difference between the official rate and the rate you're actually paying. Class 1 national insurance contributions will also be payable on the full value of the loan. There is no legal limit to how much you can borrow from your company, but you should consider very carefully how much the company can afford to lend you and how long it can manage without that money. Otherwise, a director's loan may result in cash flow problems for your company. Also, another thing to bear in mind that any loan of £10,000 or more will be automatically treated as a benefit in kind and must be reported on your self-assessment tax return. In addition, you may have to pay tax on the loan at the official rate of interest. So for loans of £10,000 or more, you should seek the approval of all the shareholders. A director's loan must be repaid within 9 months and 1 day of the company's year end, or you will face a heavy tax penalty. Any unpaid balance at that time will be subject to a 32.5% corporation tax charge. Fortunately, you can claim this tax back once the loan is fully repaid. However, this can be a lengthy process, so it's best to avoid this. Another tip is that you can't repay your director's loan and then take out another. You have to wait a minimum of 30 days between repaying one loan and taking out another. Some directors try to avoid the corporation tax penalties of late repayment by paying off one loan just before the 9-month deadline, only to take out a new one the following day. HMRC calls this practice bed and breakfasting and considers it to be tax avoidance. So note that even sticking to the 30-day rule is not guaranteed to satisfy HMRC that you are not trying to avoid tax. This is why you shouldn't make a habit of relying on directors' loans for extra cash. I mentioned earlier that you can also lend money to your company. This may be an option for you if you want to invest money into your company, for example, to fund its ongoing activities and/or buy assets, but only on a temporary basis. If you decide to charge interest, then any interest that the company pays you is considered income and must be recorded on your self-assessment tax return. The company treats the interest paid to you as a business expense and must also deduct income tax at source at the basic rate of 20%. However, the company will pay no corporation tax on the loan. So, a summary of things to remember if you're considering borrowing money from your company or lending to it. Take out director's loans only when absolutely necessary. Repay your director's loan within 9 months and 1 day of the company year end if possible. Aim to borrow less than £10,000. If you do have to borrow £10,000 or more, you must report it on your self-assessment tax return, and the company must treat it as a benefit in kind. Wait at least 30 days between taking out different directors' loans. If you lend to your company, ensure that both you and the company use the correct tax treatment. Do not allow your DLA to be overdrawn for extended periods. Be certain that your company has made a profit before you start declaring dividends. So thank you very much for joining me today. I hope this has been helpful to explain the director's loan account.